Okay, let's try and make sense of this chop and churn in the market. We've got on board with us Pramod Gubbi, the Managing Director and Head Institutional Equities at Ambit Capital, joining us on the show right now. Pramod, hi, morning. You know, in the morning, Nikunj was mentioning as to how this is like one of those turbulent flights that make you feel just very uncomfortable. We all know that this is going to be a volatile year ahead for us, but the point is, with us just about defending and getting close to 2018 lows, has the flight just taken off, or are we anywhere close to this turbulent flight landing? Is there any, end of pain in sight?
Yeah, no, I think it's just been a reminder for most market participants that equity as an asset class is a risk asset class, and risk by definition is bound to see volatility. It's just that we've had a great run over the last 12 to 18 months, which was pretty much a one-way direction, and the markets chose to look beyond any sort of events that came its way, be it demonetization or the US elections or Brexit and so on. But given the number of uncertainties that are only increasing, until now it was about US interest rate hikes and the possible liquidity withdrawal as the taper begins from the Fed. Now you have issues around protectionism. So I guess the number of factors causing that volatility is only on the rise. So to that extent, I guess we can only say that the only constant will be the volatility. And by default, when volatility increases, I guess investors tend to demand a higher risk premium, which automatically results in lower valuations, and you should see more risks to the downside, if at all, as a result of this volatility. So based on that, I think this year, I agree, is going to be volatile. In terms of direction of the market, we reckon it's likely to be downward.
Do you sense that this is going to be an elongated period of correction in the markets, or do you think the markets will be able to defend the 2018 lows? What I'm trying to understand is how worse could it get from here?
Well, it could get really worse from here, depending on how some of these factors play out. Some of these factors are so unprecedented. We don't have history to support us. There hasn't been an unwind of the Fed balance sheet to the extent that is likely to happen, and we don't know how the asset markets or financial markets will react to that. To that extent, I think a sort of liquidity going away from the financial markets, the impact it could have on levels could be anything for that matter. But I'm sure the authorities are cognizant of that and will try and make it as smooth as possible. But the chances of having the 2018 lows ahead of us rather than behind are quite bright.
So are you bearish just because interest rates are going higher? Because frankly, that adjustment is not going to be very large. I've looked at some data, and this is a 5-year data which I got from Goldman Sachs, and Goldman Sachs is indicating that every time when interest rates have gone higher in last 5 occasions, US markets have corrected anywhere between 5 to 10%, but nothing beyond that. For Indian markets, 7-8% correction has already kicked in. In mid-cap stocks, a 25 to 30% correction has kicked in. So there would be a threshold beyond which markets would say, look, interest rate is moving higher, we know that, but we are pricing that in.
Yeah, I mean, interest rates is one thing. I think, whether it's 3 hikes or 4 hikes or 5 hikes, but that's a cyclical thing. We've seen interest rate hikes as the economy recovers, and there's absolutely nothing wrong with that. In fact, it's the right thing to do. What we are suggesting is, over the last 10 years, we've seen an unprecedented infusion of liquidity by central banks across the board. We've seen the beginnings of a pause, starting with the Fed. I think the BOE and ECB and BOJ are still perhaps a year or two away from that. But this will perhaps be the first year where we'll see some of those treasuries sitting in the Fed balance sheet maturing. The question is, when that matures and the Fed sucks out the liquidity, what will replace that liquidity? Any sort of liquidity going from the financial markets is likely to have an impact, and we all know that the sort of liquidity that's been pumped into pumped by these central banks have gone largely into financial markets as opposed to building real assets in the real economy. So to that extent, an unwind of that will have to be clearly watched in terms of the impact on the markets. So essentially, it's not just the rate hikes itself, but the withdrawal of liquidity and how the Fed will stand by it or will come back with other measures to compensate for it is something that to be seen.
So you're bearish because you think liquidity will tighten and you think interest rates moving higher will have impact on the margins. But what about the other side of the equation, which is that earnings are getting better, demand is making a comeback, the global economy is at 3% higher. Somewhere we must also understand the unemployment rate in the world is at low and productivity levels are also kicking in. I'm just debating the other side of the equation, whereas I'm with you when you raise concerns about liquidity, higher interest rates, but higher interest rates are coming because global growth is coming back. Interest rates are moving higher because demand is also coming back.
You're absolutely right. I don't think we have any disagreement with that. We have a positive view on both the global economy and the local economy, in fact. But if you look back over the last 2-3 years, when we've had almost 5 quarters, 6 quarters of an economic slowdown locally, and it wasn't like the global economy was on a tear. The financial markets clearly were on a strong wicket. In fact, anticipating this sort of a recovery. So the question is, at today's valuations, how much of that underlying recovery in economic growth as well as corporate profitability is factored into asset prices? And in the event that liquidity will drive short-term movements of asset prices, in the eventuality that the liquidity moves away, will valuations hold up despite the underlying fundamentals being strong?
Pramod, so as an investor, what is it that you do? I mean, tactically, do you hide in defensives, the likes of IT and pharma, because IT clearly seems to be giving you handsome returns of late? Or are you willing to take those risky bets in spaces and sectors wherein you have seen a fair amount of fall in the recent bout of correction?
But beyond that, a couple of other things going in favor of IT, especially. The tax cuts will clearly give some leeway in terms of US corporates to increase their IT spends, but also the rising interest rate regime should mean that US financials should start increasing their earnings and hence their ability to spend on IT. So both the demand side and potentially a tailwind from the dollar appreciation should help IT in general, although it's not as cheap as it used to be, say, 12 months ago. We've seen a bit of a rally, but maybe there's more legs to go. Pharma, I guess, will still remain selective on a case-to-case basis, while the valuations are quite undemanding, and that helps positioning yourself. But I don't think all the risks that have plagued the sector are behind us. We're still looking at continued pricing pressure in the US, while the regulatory risks might, at least the worst of the regulatory risks, might be behind us. So IT in general, pharma selective will definitely be some of the recommended sector exposure. At the same time, I think even some of the local economy, remember we are in a year of general elections preceded by a slew of state elections. There's going to be government spending on rural and development programs as well as a bit of spending on infrastructure. So maybe some sectors which have exposure, particularly consumer and road builders, could also be sectors where you will have visibility on earnings growth and hence possibility of valuation sustaining over the course of the next 12 to 18 months.
Absolutely. We've seen how thick and fast and steady the inflow of road orders have been. Just as of yesterday, 3 of the road players got some sizable orders from, 2 from the state of Karnataka and another one from Jharkhand. But, while some of these names are still expensive, Pramod, what within the consumption space, within the rural pocket is looking exciting? Are these interlinked spaces, or would it be more on the consumption end with regards to FMCG names? Pramod, can you hear me? We seem to have snapped that line with Pramod Gubbi. Anyway, let him go.